everyone, welcome to the new edition of Capitals LinkedIn Live. My name is Amit, and today I'm joined here by my good friend Olivier too from Optimate. Hey Olivier, how are you?
Hi Amit, it's good to see you again. Thank you very much for inviting me to this stream. Yeah.
No worries. Thanks for joining us. Always good to chat with you. So we'll have a pretty good session today. So topics of today's conversation is all around Captables, SPVs, and what's been happening in the kind of primary fundraising stage for a lot of early stage companies and startups in Southeast Asia. So I know we have a lot to unpack. But before we dive into the topic, would love for the audience to get to know you a little bit better. So I know you had a pretty interesting career, done a few things. Would you mind just telling us a little bit more about your career journey and what led you to studying Automate and trying to solve the problem for early stage startups and fundraising in Southeast Asia?
Sure. Thanks, Amit. So I started off my career actually as a lawyer in Luxembourg, Luxembourg qualified lawyer, mostly on the M&A side, and then quickly moved to a big corporate service provider called Vistra in Luxembourg initially. And then did 10 years in Singapore, 1 year in Malaysia, before deciding to get into entrepreneurship. My shift was mostly motivated by being a little bit frustrated by how things were done in the, I would say, legacy type of structures, and really wanting to help, I would say, the ecosystem by offering a solution which is digitized, less costly, and much more streamlined. So when we set up Optimate at the real tail end of 2022, we had as an ambition to come up and help deals being done in the region, and really built I would say, angel list, to give a comparison of Asia in that sense, by helping setting up investment vehicles. So me and my two co-founders, we accumulated over 50 years cumulative experience in the corporate services, legal, funds industry. And we bring that to the table, again, just being motivated by just changing the way deals are done in the region.
Yeah, awesome. And I think you guys have picked a pretty good time to start this off, because as you can appreciate, the environment and the startup VC like fundraising ecosystem the last couple of years have been a little bit more challenging. So I'd love to spend a little bit more time on kind of this topic, focusing early stage companies. So we all know that there's many different ways to raise capital, and capital has been a bit harder to find in the recent months and years. So do you want to tell us a little bit more about what are some of the pathways like early stage startups in Southeast Asia can attract the capital, and maybe the role of angel investors? Because that's one of the angles you can try to assist companies in terms of fundraising. You mind telling us a little bit more about that?
Yeah, absolutely. I think, Amit, you've hit the nail on the head here. What we've seen in this, what we called the funding winter last year, there's been really a shift from proper institutionalized VCs, from looking at really early stage as an idea, just as cheap to invest in, which they did, pre and during COVID, to now, if you talk to if you're a startup founder and if you talk to VC, they will say, come back to me when you're profitable, when you have a path, or at least have a path to profitability, when you've reached $1 million in revenue, and so on and so forth. So what it means is that for a number of startups that are starting to get a little bit of traction, are about to get their products out there, it's harder and harder to get the required level of financing to get to that next level and to build that growth. We see VCs not investing so easily in just a growth idea, and really wanting to have strong fundamentals across the board. So what happens is that as a startup founder, you have the option to go to your friends and family, your network, to get some funding. If you are a repeat founder in a business, that's not much easier because you already got that network. But if you're a first-time startup founder or co-founder, it's quite difficult to get 200, 300, 500K of financing to get to that level where you are in a position to be somewhat have a path to profitability, get the start of a product market fit, and so on and so forth. So that is a gap, and we've seen that really, it's been proven by our success last year. A gap being filled by what we call syndicate of angels, or individuals or setups that are just bringing in a number of small ticket investors together to build a bigger ticket to invest in the startups. On average, what we've seen, it's ticket size between 100 to sometimes 300, 500K. Of course, you've got outliers as small as 50K and as big as few million. But this is really where we see the sweet spot currently. You want a deal done quite quickly with not the level of due diligence a VC has. The syndicate would do some element of due diligence, but not to that extent, and really give those startup co-founders what we call a seed round or even a pre-seed round to get things really to the next level. So and it's even furthermore the case for startups which are not necessarily in Singapore, in more developing markets. We see that in whether it's in Bangladesh, Pakistan, more South Asia, Indonesia, Thailand. It's not as easy to raise funds as it is if you're set in Singapore, and their ticket size are small. So there's a really lot of good deals out there, and they just don't have access to that funding. This is where we believe, and we've seen, it's not just a belief, there's a gap that's been filled by what we call syndicate of angels.
Yeah. So I want to take a sort of step back to help kind of everyone in the audience understand the whole concept of angels and syndicates a little bit better. Because a lot of times when you first hear about angel investing, you always read about accredited investors, wholesale investors, institutional, sophisticated, whatever it's called in different jurisdictions. So kind of the misconception potentially is like, oh, you need a whole bunch of money to be able to invest into startups. But then at the same time, you hear about all these syndicates who gets a lot of angels together so they can invest, all in one go as one big, group or a syndicate as it's called. Do you want to explain a little bit more for the audience? How does it actually work? What's the difference between individual angel that may enter your cap table and invest directly into the company versus working as a founder with a syndicate of investors? What is the difference? What are the pros and cons of the structure?
Yeah, happy to cover that. And there's benefits for the investor side on the startup side, absolutely. So you're right to put that distinction. I think when you think about angel investing, it's really coming in very early stage startups where there's really not much happening. It's based usually on the trust of the team, of the idea, the core premise, but maybe a very early traction in the business. And the ticket size are typically low. You're right to say it's not 100K or 200K, although you have super angels that come in. But on average, an angel investment, what we've seen in our data, it says it's ranging between 10 to 20K on average. So that's the sweet spot for US dollars as an angel ticket. Now, when you start your very, very initial round, you might get these angels directly. You typically raise it through a safe note. You don't give them direct equity from day one. And the idea is that it's just investment. They put faith in the business and put the money in from day one. Now, the premise, a little bit like a VC fund, in order to do successful angel investing, you need to repeat a number of different angel investments, because by definition, an angel investment is risky. It's you're investing in the startup. There's a high chance of failure. So to make sure that you multiply your chances of getting a successful return, you need to diversify your portfolio. And this is why angels usually do 10K here, 10K in another startup, and they do that maybe on a yearly basis into 5 to 10 startups, depending, of course, on how much they earn. So that's the classic trend of what an angel is. But what we see is we've seen some platforms getting even lower, allowing an angel ticket size of 3 to 5K. So I've made myself, for example, a angel investment of 3K, but that would have only been possible because I did it through a syndicate of angels. Going directly to a startup and me asking questions and them dealing with the documents, it's too low of a ticket for them to entertain that. So where does syndicate fill the gap is in the syndicate you have a lead that usually driving the deal, sourcing the opportunity and bringing that opportunity to his, her, or their network of angels. The angels put trust in the lead, see the deal, they trust that the lead would negotiate good terms, and because of course the ticket size in the pooled angels is a little bigger, the syndicate lead can negotiate better terms with the startup. So me as an angel investing through a syndicate as opposed to directly in a startup, I get the comfort of somebody actually looking even more closely at the deal, and somebody who is going to look after my interest in negotiating deals with the startups, and also on a continuous basis deal with the startup. For the startup themselves, it makes it easier because they only have to deal with one lead that's going to aggregate 100 or 200 or $300,000 worth of angels there. Of course, for a lead in a syndicate, the idea is to do repeat deals and have these different members of the syndicate participate on a deal-by-deal basis in a number of different deals that they bring to the table. So our clients, which are syndicate leads, typically come in and use our SPVs again and do repeat deals. And each deal has different investors depending on the preference of the investor and whether they see and they want to opt in that specific deal or not. So syndication helps bring a bigger ticket, more helpful for co-founders because they don't have to spend the time with all these 10, 15 angels. Instead, they deal just with one lead. From the lead side, they can charge a fee, and they typically charge a carry as well to reward in the syndicate to reward their efforts. And from the investors coming into the syndicate, well, it's the ability sometimes of doing very small tickets, which should not be able otherwise, and to have that comfort that somebody is looking after the interest and managing the relationship with the startup.
Yeah, awesome. Yeah, so you talked about setting up SPVs, and I think we'll spend some time on that to kind of truly understand what it all means. But before we do that, I kind of want to talk about the integrity of a cap table. So at Captable, we look at thousands of cap tables all the time, and you always hear about a concept of a messy cap table, how can it cause issues down the track. So what we've been talking about is like really one of the earlier rounds of external funding, when you get a syndicate or angels or families, friends, and family invest. So my question for you, like, would you mind kind of talking us through the importance of planning ahead and managing your cap table? How do decisions you make now in terms of who invests in your cap table, how you're going to structure it, will impact your future fundraisers? What are some of the things that I guess funders need to keep in mind so they avoid any problems down the track? So why a clean cap table important?
Oh, absolutely. I think we've seen that, we've experienced that firsthand, startups coming to us to help with cap table cleaning exercises by putting an SPV in place just before they have the round of the VC. So you have to remember that this type of problems only typically kick in when you've got a round of institutional investors coming in, and they start doing the due diligence, they look at the structure, and institutional investors don't like what you've pointed out, messy cap tables. Too many individuals, too many people to have to deal with, because down the line, if in the case of an exit, in case of a sale of the business, that will require involving too many different individuals, and you don't want to have to deal with that. From a startup co-founder, on top of that, there's a lot of administrative hassle as well to deal with direct investors on your cap table. So I think what we've seen on the market is now more and more the early stage instrument preferred is the safe note. Why? Because you don't get the investor directly on the cap table, at least legally speaking. Of course, from Capita standpoint, you're still somewhat on the cap table, and so you defer a little bit that problem until the day, of course, the safe note converts into equity. But what happens on the day they convert into equity? Do they get directly equity in the startup, or have you already planned for them to be put in the vehicle where you aggregate smaller ticket investors? So what we've seen is indeed startup co-founders from day one thinking already ahead, and often these are repeat startup founders. They've already experienced it the first time in their previous business, and then they're like, okay, now I value a lot a clean cap table. So there's a big difference between first-time founders and second-time founders. Second-time founders will really rate that as a very high, important aspect of it compared to usually first-time founders. And I think this is where it's important as well to make sure you have a cap table tool. You have something in place at least to to make sure you don't dilute yourself too much. You understand, you run scenarios on what will happen in case of a conversion event, how much percentage are you giving up, and then so on and so forth, because it can become quite complicated. A safe note is a very simple instrument to put in place, but depending on the valuation cap, discount rates, and so on and so forth, the scenarios can be very multiple and can be very complicated to know you as a founder how much equity you'll be left with upon a conversion. So to come up to the initial premise of messy cap tables, very important to ensure that you don't end up you don't give equity too early to angel investors, because that would dilute yourself and put you into trouble. Keep control of your vehicle, and if possible, park them in. We strongly recommend parking them in SPV because it limits your administrative hassle. So when you need to do your AGMs or your administration or any sales, you only deal with one big investor, which is the SPV, as opposed to a myriad of and a number of different small ticket investors.
Yeah, awesome. So let's talk a little bit more about SPVs. So let's say I'm going to quit Capita tomorrow, start my own business. I have 200 friends. They all want to invest in me because my idea is amazing. So, and someone told me about SPV. So I want to start it up, but I have no idea what it is. So do you mind explaining what is an SPV? What's the legal structure? How it functions on a day-to-day? What are the benefits of it? How does it work?
Yeah. So an SPV stands for special purpose vehicle. It's a vehicle that's set up for one unique purpose, and it's to hold an asset. I would say typically, because there's all the type of SPVs, but in broad terms, at least for the purpose of this discussion, is to hold an equity stake or a safe note or an instrument issued by a startup. So our angel SPVs, they're set up to aggregate these investors in, to make sure that you don't have to, at the level of your startup, give too many different terms and so on and so forth. The benefit of putting your investors in an SPV are you make sure there's alignment of the terms. So you say, well, the SPV will sign a big safe note with this valuation cap and this discount rate. And if you're an investor that's going to commit less than 100K, you're going to go into your SPV as opposed to directly on the cap table. And you can't really negotiate the terms because these are the terms. So it allows you as a founder to push a little bit more pressure on signaling that if you're a small ticket investor, don't come and negotiate with me terms, because the terms are quite set, right? That's in an SPV set up by the founder, right? So you as a founder, you set it up to aggregate. The other benefit is actually your investors. Sometimes some investors might not be familiar with safe notes. They will actually get equity in the SPV.
Yep.
So they get shares in the SPV. So the narrative is you're getting an equity, you're getting a share certificate. So it's all psychological at the end of the day, because the SPV will hold a safe note in your startup. And on top of that, you don't have really necessarily to deal with all the administrative hassle upon a conversion, where they all come in and you need to deal and send independent notice here and there. You just convert one and it's held by the SPV. By the way, your founder SPV, as a founder, you control it and you manage it. So you handle the communications with your investors. Now that said, you don't have necessarily to set up the SPV from day one. There's another option, is you issue the safe note, but in the safe note you insert a clause saying upon conversion you might be grouped in an SPV. So this is why what we sometimes recommend, some founders that don't necessarily want to set up the SPV from day one, or don't necessarily see the need to do so, so just delaying and deferring the time when you set up the SPV. So for example, us, we did our first round of friends and family fundraising. We just issued safe notes directly. Now for seed round, we've set up our own Optimate Angels SPV, where we're bringing in tickets of less than 100K. Any investor that will invest us more than 100K will get the safe note directly on our cap table.
Okay, sounds good. So in terms of, like, if someone wants to create a checklist of setting this up, so how early should you start planning and thinking ahead, right? So I've started my business. I'm looking to raise capital, let's say, towards the end of the year. Should I start worrying about this SPV now? Can I leave it till later? like if you can outline sort of a timeline that the founders and the audience can sort of follow, what's the best way to be prepared and structure and plan ahead?
I think as you probably know, fundraising is a tough thing. It's an ongoing thing. So you have a lot of discussions, and by the time people commit and sign documents, it takes a while, and that's not even tracking them to pay the money in. So this exercise typically could take a long time. I wouldn't say, although we've seen some of our clients deciding to set up a founder SPV from day one. So they set up their opco or their startup entity, and then immediately thereafter set up the SPV. I would say you don't necessarily need to think about it immediately. Think about it when you start seeing that you've got a reasonable amount of interest, and you might see that you have a lot of small ticket investors. So be ready maybe to mention it to your investors, potential investors, that they might be put in an SPV. Piece of advice: use what we've said maybe, and you put a threshold and say if you invest less than that amount, you get into that SPV. If it's more, you'll be investing directly on the cap table. Sorry, on the startup side. So if you do want to limit your hassle, of course, setting up a founder SPV with us, with Optimate, you've got a tool then that allows you to monitor and manage really the whole thing. We prepare the documentation and we issue the certificates and make sure the vehicle is done. However, that comes as a cost, right? Because you of course need to set up and pay for the maintenance of the SPV. So I would say give it a thought. The cost is not horrendous, but think about it that if you start seeing that you might have around $100,000 worth of angels, you're reasonably certain that you're going to close $100,000 worth of angels, and then the ticket size is 10, 20K. That might make sense to set up the founder SPV at that point in order to group them in. Alternatively, as I said, you can make sure your safe notes have that clause that they might be put in this, that you're allowed to put them in the SPV upon conversion, in which case you only set up the founder SPV upon the price round, upon the funding event.
Yeah, makes sense. No worries. So that I think explains the structure and the process. And you've kind of alluded to sort of ongoing management administration. So what do founders also need to keep in mind on an ongoing basis? Let's say you've closed your pre-seed, seed round, you had a price round, Series A as well. Like, what's sort of the life cycle of SPV? What are some of the things the founders need to keep in mind long term as you obviously aim towards ultimate exit down the track?
Yeah, I think the benefit of an SPV, and we didn't really touch on that topic, is the liquidity aspect of it for the investors in the SPV. It makes the investing a little bit more liquid because they can transfer their shares to third parties more easily, as opposed if they were directly on the cap table. And it makes it a little more attractive as well for a potential bigger investor to acquire the whole stake from the SPV, as opposed to having to negotiate individually with all these investors on the cap table. So I think there's also a benefit from the investors. I would think that if you're a small ticket investor, it's better to be in an SPV than directly on the cap table, because you have less hassle and you benefit from the same economic rights anyway, and information rights. So the point is, of course, psychologically, some angels say, no, I want to be directly on the cap table where the activity is, the IP is, and all of that. But I think it's not an argument that really is very strong. I think it's better to be in the SPV because then I can sell my shares in the SPV in a much easier manner than if I had shares or a safe note, right, on the cap table. So I think that's an additional benefit. Yes, the life cycle of the SPV, it depends. It can last until there's a listing. It could last until somebody wants to buy that. So when a VC institutional comes in, they might be interested to make an offer to the SPV to purchase at a certain value, maybe slightly discounted from the price one. But then as an SPV, you really make potentially already a markup. So the way the founder SPV functions is that the majority of the investors need to approve the sale in order for the sale to go through. But there are better exit opportunities when when this happens. And in which case, if the stake in the SPV is sold, well, we close down the SPV and it's been struck off.
Yeah, excellent. Yeah, I think you raised a couple of good points, right? Like long-term liquidity, actually, how does it look like? Because I think there's a popular saying, it's hard enough to get anyone on your cap table, it's even harder to get rid of them, for either good or bad reasons. So that's why, it's an important thing to consider. And I guess the other element, like in the whole benefit of angel investing, it's also, I guess, the network effects of, having, more individuals, supporting your business and helping you grow, can lead to additional positive impact. While at the same time, if you use SPV, you've been a little bit smarter about it in terms of like, managing effectively. So I think that's quite helpful. So I think we've kind of, gone through like the theory behind it, angel investing, things to keep in mind, sort of the long-term outlook as well. So to kind of, bring our conversation to the close, I want to take a step back and talk a little bit more sort of the macro environment. So I know you operate obviously based in Singapore. You do a lot of work across Southeast Asia and broader Asia region. I guess as many of us are not surprised that a lot of the investment does happen in Singapore. Right, but it's also important to keep in mind that some of the startups have ambitions to go global, other jurisdictions. So my question for you, like given your experience in Europe and you've done some work all over the place, how do you sort of see the Southeast Asian ecosystem, in comparison to some of the global markets? What are some of the unique aspects that founders and investors need to keep in mind on? How does it compare to, I guess, slightly more mature markets in terms of fundraising, like the US? We'd love to hear your thoughts on the macro level.
Yeah, I think it's a good point, and let's not kid ourselves. I think we still have a lot to catch up to do in Southeast Asia, and whether it's in the venture ecosystem, in the startup ecosystem, compared to very mature markets like the US, right? So of course, for example, AngelList has been operating and doing angel syndicates for over 10 years now in the US, whereas in Asia we feel like it's just almost starting. So there's still a shift in how funding goes. I think what we've seen, VC in Singapore, for example, has only existed for 10 years. Really, if we're really honest about it, it's not been like a track record of 20, 30 years of operations. So I think we're starting to catch up with how things are done. Investors are getting a little bit more mature. You see the first rounds of successful exits, which brings a number of employees and ex-co-founders that themselves become, investors and angels and drive a little bit the ecosystem. So I think that was a little lacking before, and now it's starting to happen in the last 5 to 10 years. There's been more in the last 5 years than anything else. So I think that's a very positive development. There's compared to the US and Europe, we don't see as many big rounds of early stage investments. So the rounds are a little smaller, syndicates are smaller, even the VC Series A rounds are smaller. So everything is at a slightly smaller scale, and things are not as quick and ready because everybody's trying to get a grip to it. I would think angel investment historically in the region were done by very big, like super angels. And now we're starting to see a push towards, I would call it democratization of angel investing. Maybe some mid-level senior employees started doing angel investments, and you start having more individuals doing this as a hobby as opposed to doing it in the stock market or wanting to diversify their investment asset allocation. And now with certain platforms, as I said, like for example myself, I can't proclaim like I'm a super angel or anything of the sort. I've done a handful of angel investments, as low as very, very, very small ticket size. That makes it very accessible for individuals. So I think the next step is really how you broaden and you allow, I wouldn't say retail customers because it's still a very risky investment, but you allow individuals to have access to that if they are sufficiently know what they're doing to be able to do that. It wasn't possible in the past. A startup wouldn't entertain an angel ticket for $2,000. Now it's possible. So and thanks to SPVs and syndication, I would say it broadens a little bit the number of angels that come in. This trend already existed in more developed markets. It's starting now in Southeast Asia.
Okay. So I want to pick on a couple of words you said. You said next steps, but what do you think is next for the ecosystem? I know you talked about funding winter, everyone's favorite term the last couple of years. But what do you see the sort of ecosystem heading? What are your predictions? Are you feeling a little bit more bullish? Do you see more activity, or things are still, going to take some time to, I guess, get closer to the 2019 levels of activity?
I don't think we'll return to the bullish 2019 level of activity where VCs will be just meeting a co-founder or founder and say, "Oh, a lovely idea. Here's a $3 million check." I mean, these stories happened back in the day, right? Seemed to be so much money. That said, there's still a lot of money out there. There's still a lot of money. It's just that VCs are a little bit more cautious. I think now that they've probably underwent their exercise of looking at a portfolio, rationalizing a little bit more, understood the risk and seeing how they want to do their impairments, they'll start opening the purses again because they do need to deploy the money, right? They can't sit on this dry powder forever. It doesn't look good towards their LPs, and they have a mandate to deploy it. So I think there's been a little bit of buzz around AI, and you've probably all heard that if you put AI in your deck, and suddenly you become more investable, and there you can maybe generate more. But I think most of the discussions we had with VCs, they really look at business and say, okay, what's your path to profitability? Come back to us when you have that million, this magic number now, $1 million in revenue, and then we can talk. I'm not saying this is across the board for every single type of business, but it's become a little bit of the yardstick. So I don't think that's necessarily going to go back to the heydays of 2019. But I think it's a good thing. I mean, it's good for the startups that do have legs, that are really implementing, are really showing that they are. It means it's going to be a little harder for startups to prove themselves, have a product, build something in a lean manner, bootstrapping for a little longer than they used to be. But down the line, it will be good for the whole ecosystem because funding will come to the startups that are really good. In the meantime, coming back full circle in the initial of our discussion, this is where angel syndicates and angel investment comes in. So you would see more angel investment continuing until I would say almost a pre-Series A or Series A round. And separate to that, another trend, I think we are seeing smaller, very boutique VC firms doing very smaller checks, seed round, seed checks. We were thinking that there will be more and more of these outfits, very specialized, might not be big funds, maybe $2-3 million funds allocating 100K in a number of early stage startups, and I think this is coming more and more in the region, whereas in the past it wasn't really that developed. So I think that's something that we fill again the gap in that.
Sounds good. Well, look, now that you've come full circle, I think it's quite a logical step for us to wrap up this conversation. I think that was super helpful. Look, I'm sure you have better things to do with your day than chatting with me, but I do appreciate you joining us and providing some insights. I think that was quite helpful. In case anyone watching now live or going to check out this recording or the video on LinkedIn in days to come and are keen to learn more about SPVs, how that all works, what will be the best way for them to reach out to you? Is it LinkedIn, email, or can they find you somewhere else?
I think the easiest way is to find me on LinkedIn. My name is quite unique, so I mean that's only one of Olivier too. So you can find me on LinkedIn. Reach out to me. We can connect. Alternatively, you can reach out to me on olivier.2@optimate.com. I'd be happy to have a chat. We can schedule a call or something of the matter. But that's the best way to find me. Amit, thank you very much. I really thoroughly enjoy, so I don't think it's I don't have necessarily that many better things to do. I really enjoy that. Put on the spot and thinking about how this ecosystem evolves is always a good thing. And as fellow professionals in the field, we have of course a vested interest in promoting and pushing it to the next level. So and again, thanks to Capita for organizing that. And hoping to catch up again soon, Amit.
Sounds good. Awesome. Thanks, Olivia. Really good seeing you. So thanks all for tuning in to this episode of Capital LinkedIn Live. Keep an eye on further discussions. Next week, we'll be talking about the employee share option schemes in Malaysia and a few more conversations coming up down the track. So see you around. Thanks all. Cheers.